The stock market determines the price of a stock by an auction process. The seller of a stock asks a price for that stock and the buyer bids a price. When the ask and bid price is matched, the transaction happens. The price is often a reflection of supply and demand of a stock at that moment. When more people want to buy a stock than sell it, the price will tend to rise. When more people want to sell a stock than buy it, the price will tend to fall. The supply of a stock is largely determined by the number of shares that are available for trading, which is generally fixed. The demand for a stock, on the other hand, can be influenced by a wide range of factors, such as the performance of the company, the state of the economy, and investor sentiment. The process of buying and selling stocks can be summarized in the following 7 steps. 1. Orders to buy and sell stocks are placed through brokers, who execute the trades on behalf of their clients. 2. These orders are then sent to a stock exchange, NYSE or the Nasdaq, where they are matched with other orders to buy and sell the same stock. 3. The stock exchange uses a system, called an order book, to match buy and sell orders based on the price and the time the orders were placed. 4. If there is a match, a trade is executed and the stock is transferred from the seller to the buyer at the agreed-upon price. 5. The price at which the trade is executed is called the market price. This market price is determined by the supply and demand for the stock at any given time. 6. As new orders are placed and matched with existing orders, the market price of the stock may fluctuate. 7. The process of matching buy and sell orders and executing trades continues throughout the day as long as the stock market is open. There are also various financial metrics that analysts use to evaluate the value of a company and its stock. Some common metrics are earnings per share, price-to-earnings ratio, and dividends. These metrics can help investors determine whether a stock is undervalued or overvalued relative to its peers or to the overall market. However, it is important to note that the stock market is forward-looking. The price of a stock reflects investors' expectations about the future performance of the company and the overall market, rather than just its past performance. Thanks for watching. If you enjoyed our content, please like and share it. And don't forget to subscribe for more videos. We appreciate your support and can't wait to share even more amazing content with you.